Most people look at a company's balance sheet and think this is too complicated. So many numbers. Like, what does any of this even mean? But here's the truth. Once you understand three simple ideas, a balance sheet becomes as easy to read as a school report card. Today, I'm going to break it down in the simplest way possible. No complicated accounting, no finance jargon, just clear explanations and real life examples so you can understand any balance sheet confidently. By the end of this video, you'll be able to look at a company and instantly know whether it's financially strong or secretly struggling. Let's begin. What a balance sheet really is. Think of a balance sheet like a photograph. It shows the company's financial condition at one specific moment. Three things are inside that photo: what the company owns, what the company owes, what the company is really worth. In accounting language, these are assets, liabilities, equity. That's it. If you understand these three words, you can understand everything else. Assets, what the company owns. Let's start with assets, the things a company owns or controls. There are two types. One, current assets. These are things that can turn into cash within a year. Examples: cash in the bank, money customers owe them, called receivables. Inventory, products waiting to be sold. If a company has strong current assets, it means they can run day-to-day operations smoothly. Two, non-current assets. These are long-term assets that help the business function. Examples: buildings, machinery, vehicles, computers, long-term investments. These don't turn into cash quickly, but they help the company make money. Simple example: imagine you run a small bakery, cash, Yokan dan Rs $50,000. Raw materials, Mokan Rs $20,000. Oven machine, Dokan Rs $100,000. Delivery vehicle, Bukan Rs $80,000. These are your assets. They help you earn money. Liabilities, what the company owes. Liabilities are debts and responsibilities. Two types again. One, current liabilities, debts. The company must pay within a year. Examples: supplier payments, short-term loans, electricity bills, salaries due. Two, non-current liabilities, long-term debts. Examples: long-term business loans, bonds, lease obligations. Simple example from our bakery: loan from bank, bar RA1 50,000. Payments due to suppliers, bar Rs 25,000. These reduce your financial freedom. Equity, real owner's value. Equity is very simple. Equity, tan assets, liabilities. This tells us what the business is actually worth after paying all debts. In our bakery example, total assets na Rs $250,000, total liabilities na R175,000, equity na 75,000. That's your real value as the owner. The golden equation: every balance sheet follows one rule: assets, liabilities plus equity. This is the art of the balance sheet. If something changes on one side, the other side must adjust. Once you understand this equation, nothing in a balance sheet is scary. Three things to check in any balance sheet. Now that you understand the basics, here are the three most important checks investors do. One, liquidity. Can the company survive day to day? Look at current ratio, current assets, current liabilities. If it's above 1, the company can pay its bills. If it's below 1, that's a warning sign. 2, debt levels. Is the company over borrowing? Look at debt to equity ratio, total debt, equity lower ratio, dark safer company, higher ratio, vision risky company. 3, asset quality. Are assets actually useful? Does the company have too many receivables, customers not paying, too much inventory, products not selling, too much useless equipment, healthy assets at healthy business? Real world mini examples. Example 1. Strong company assets, 500 crores. Liabilities, 200 crores. Equity, 300 crores. Low debt, strong cash flow. Banks trust them. Investors trust them. Or example 2. Weak company assets, 300 crores. Liabilities, 280 crores. Equity, only 20 crores. One bad quarter, and they may collapse. This is why reading a balance sheet matters. How to practice reading balance sheets. You don't need special software. Just search for company name plus annual report plus PDF. Inside that report, go to financial statements, balance sheet. Start with companies you already know. Reliance, Tata Motors, HDFC Bank, ITC. Read the assets and liabilities. Compare year to year. You'll understand patterns quickly. Now, you know how to read a balance sheet in the simplest way possible. With just a few minutes of practice, you can understand whether a company is strong, weak, risky, or growing. If you want me to explain the income statement or cash flow statement in the same simple way, comment below and I'll make that video too. Don't forget to like, share, and subscribe if this helped you.